Welcome to the Deep Dive, the show that really cuts through the noise. We deliver the core insights you need to be truly well-informed. Today, we're taking a structured analytical look at Eos Energy Enterprises, that's ticker EOSE, and their Q2 2025 earnings. Our mission? Well, it's to move beyond just the headlines and really understand what's happening with this company's performance. We want to give you the full picture, without the usual information overload.
That's exactly right. The goal here is to give you a comprehensive understanding quickly and efficiently. We're using our robust five-part framework to really dissect EOS's official earnings press release. We integrate their reported data with verified real-time market expectations. And this approach, it really helps you gain a rapid yet thorough grasp of the company's situation. Cuts right through all the noise you might find elsewhere.
Okay, yeah, let's unpack this. Now for slide one, the at-a-glance scorecard. So Eos Energy Enterprises reported what they called record quarterly revenue, and it certainly indicates, significant operational scaling. However, here's the kicker. The top-line figure actually missed Wall Street expectations, and their reported losses widened considerably, so quite the contrast there. Let's dive into the numbers for Q2 2025. Revenue came in at $15.2 million. Now, that's an explosive. A 1,597% increase from the $0.9 million they reported just a year ago in Q2 2024. That's genuinely massive growth.
Jump, yeah.
But despite that impressive leap, it was still a miss against the consensus analyst estimate. That was hovering around $24 million. And on the bottom line, the giant net loss attributable to common shareholders was, well, a whopping $248.8 million. That works out to 1.05 per diluted share. Yeah. Compare that to the prior year loss of $51.8 million, or 0.25 per share. That's a 380% increase in the net loss. Their non-GAAP adjusted EPS showed a loss of 37.6 per share. This also was a miss against the consensus estimate, which was looking for $1.16 loss per share.
Okay, and here's where it gets really interesting. You see that massive revenue growth, but then this significantly wider loss per share. It demands a deeper look, right?
Yeah.
Because the core reason for this ballooning net loss isn't really a deterioration in their fundamental business operations. Instead, it's largely due to significant non-cash expenses hitting their income statement. Accounting stuff, basically.
Okay. Non-cash.
Exactly. And what's fascinating is that while revenue surged by nearly 1,600%, their operating loss, which, that truly reflects the performance of their primary business activities, it grew at a much slower rate. It went from about $29.0 million to $63.8 million. That's a 120% increase. Now, compared to the revenue growth, that's actually an encouraging sign for you as a listener. It indicates improving operational scale. The costs to run the core business are growing much slower than the revenue they're bringing in.
Right, that makes sense. So where did the big gap loss come from then?
The primary driver is found down in the other expense income section of their income statement. This section contained over $150 million in large non-cash charges. So think of these like entries on paper that don't involve cash actually leaving the bank for operations. For example, there was a $76.5 million loss from change in fair value of derivatives and a $57.9 million loss from change in fair value of warrants. Yeah, it's complex, but imagine EOS gave out IOUs that convert into stock or become more valuable if the stock price rises. When the stock goes up, those potential obligations are suddenly worth more on paper. And accounting rules make EOS record that increased potential obligation as a loss, even though no cash was spent in the quarter related to that.
Got it. Accounting rules, not operational spending.
Precisely. There was also a $49.1 million loss on debt extinguishment. That's basically a one-time accounting hit from restructuring old loans, a specific event, not something recurring from ongoing operations. So yeah, the ballooning net loss was largely an accounting consequence, and it kind of masks the improvements in their core manufacturing efficiency. There's also a 12.6% year-over-year increase in the weighted average shares outstanding, which does spread the loss over more shares, but these non-cash charges were definitely the dominant factor.
Okay, that clarifies the headline loss quite a bit. Let's move to slide 2. The engine of profitability. So, to truly understand the health of EOS's core business, we need to look past that big gap loss, like you said, and analyze their margins and the non-GAAP metrics. This is where we can really see the operational picture. Let's dive into the margin analysis. Their gross margin was reported as deeply negative, 203.2% for the quarter on that $15.2 million revenue. Now, that sounds rough, right? But it represents a dramatic improvement from the 1,466.9% reported back in Q2 2024.
Huge improvement, relatively speaking.
Yeah. So how did they manage that while still being so negative? Well, management actually attributed this significant improvement to increased production volumes and operational efficiencies. Basically, they absorbed fixed costs better. Though they did say this progress was partially offset by what the company described as one-time lower than average selling prices.
Hmm.
Now, when we look at the operating margin, the operating loss of $63.8 million yielded an operating margin of 419.1%. Again, a substantial improvement from that. Really eye-popping 3,233.5% in the prior year quarter. The key driver here seems to be operating leverage. Total operating expenses grew 108% year over year, which, like you noted, is far slower than the 1,597% revenue growth.
Exactly. That clearly indicates EOS is starting to scale its operations much more efficiently.
So costs aren't rising nearly as fast as sales.
Right. And the critical distinction here is that vast difference between EOS's GAAP net loss of, what was it, $222.9 million and its adjusted EBITDA loss of $51.6 million. For investors, for you listening, understanding why this distinction is crucial helps you cut through that accounting noise and focus on the underlying business performance.
Okay, so break down those adjustments for us. How do you get from that big gap loss to the smaller adjusted EBITDA loss?
Sure. So first, there's a total of $102.8 million net added back for the change in fair value of derivatives and debt. Like we discussed, these are non-cash accounting charges tied to the changing market value of the company's warrants and convertible debt. They relate to stock price moves and financing structures, not the day-to-day business of making and selling batteries.
Okay, yeah, that's...
Second, that $49.1 million loss on debt extinguishment charge was added back. Again, this is seen as a one-time accounting loss from a recent debt restructuring, so it's excluded because it's not expected to be a recurring part of their operations.
Makes sense.
And finally, $7.1 million in stock-based compensation, another non-cash expense, was also added back. Now, stock-based comp is a real expense. It dilutes shareholders over time, but it's excluded from adjusted EBITDA specifically to give a clearer reflection of the cash performance of the business in that period.
Right. So what does this all mean in the end?
Well, what it ultimately translates to, for your understanding, is this. The adjusted EBITDA loss, it offers a clearer, maybe more favorable view of the cash losses coming from EOS's core operations. It tells a story of improving efficiency. However, and this is vital, you have to remember that the items excluded from adjusted EBITDA, particularly stock compensation and the impacts of debt, they have real long-term consequences for shareholder value, even if they aren't cash outflows this quarter.
So don't ignore them completely.
Definitely not. It's not just an accounting quirk. It really highlights how vital it is for EOS to hit its operational targets. Because the real costs of their financing, though they look non-cash now, could become a significant future burden if the company and the stock doesn't perform.
Understood. Okay, next up, slide 4. Financial strength and shareholder rewards. For a pre-profitability growth company like EOS, the balance sheet and cash flow are just paramount. They tell you if the company can actually fund its operations and, frankly, survive until it can generate sustainable profits. And Q2 was a critical period, really defined by a major recapitalization.
A very big one.
Let's look at the key balance sheet metrics. Their total cash equivalents, and restricted cash increased by nearly $80 million since the end of 2024. It reached $183.2 million as of June 30, 2025. That's compared to $103.4 million back on December 34, 2024. Now, it's interesting. The specific cash and cash equivalents line actually decreased slightly, but the comprehensive figure, which includes restricted cash, increased.
Right, and restricted cash is important to distinguish. It's money they have, but can't necessarily spend freely. Maybe it's collateral or earmarked.
Exactly. So the overall picture still signals enhanced liquidity, more breathing room. The drivers of this enhanced liquidity are pretty clear. They closed on $336 million in concurrent offerings of common stock and convertible senior notes. That's huge. And they also got a $22.7 million loan advance from the Department of Energy.
Yeah, significant capital injections.
Management themselves call these transformative transactions, providing financial flexibility, and you can see why. At the same time, their total liabilities actually decreased by about $90 million to $842.1 million. And their total deficit, or negative equity, it improved by $32.5 million, though it's still a large deficit at $1,070.5 million, reflecting those accumulated losses.
So the recapitalization definitely strengthened the overall balance sheet structure, even with that big historical deficit.
Right, but for a listener just seeing that widening gap loss we talked about, isn't it easy to just write this off as another struggling growth company despite the cash injection?
That's a really important point. And it raises a crucial question for any investor. What about capital return and shareholder dilution? Well, as a growth stage company investing heavily in expansion, EOS simply does not pay a cash dividend to common shareholders, nor do they have a share repurchase program currently active.
Okay, no dividends.
No. And you might see something mentioned in the report, a $4.5 million down round deemed dividend. It's important to clarify this is a non-cash accounting entry. It's related to preferred stock financing, not a cash distribution going out to common stockholders like you or me.
Gotcha. Accounting again.
Exactly. So instead of returning capital, EOS is very much in the phase of consuming capital to fund its growth. And this process inherently requires issuing new shares, which dilutes existing shareholders. We saw this directly with that 12.6% year-over-year increase in their weighted average share count. More shares outstanding means each existing share owns a smaller piece of the pie.
So what's a trade-off for investors then?
The core takeaway here is that for EOS investors, the potential reward isn't income from dividends. It's all about capital appreciation, the stock price going up. And that is entirely dependent on the company successfully using these funds, this new capital, to actually achieve profitability down the road. The fact that their recent offerings were apparently significantly oversubscribed, well, that suggests there's strong investor appetite for this particular trade-off, despite the known dilution. It's clearly a bet on their future execution.
A bet on the future. Okay, finally, let's look at slide 5. The road ahead management's outlook and key takeaways. So management's commentary and their forward-looking guidance, they signal pretty strong confidence in the company's ability to accelerate its operational ramp-up in the second half of the year.
And
That's even after missing those Q2 consensus estimates.
they're sticking to their guns.
They really are. The most crucial statement from management was their reaffirmation of the full year 2025 revenue guidance. That's $150 million to $190 million. Now, think about the implication of that. To hit even the midpoint of this range, say $170 million, EOS needs to generate approximately $139 million in revenue in just the second half of the year.
Wow, okay.
That's a dramatic increase from the $25.7 million they reported in the entire first half. I mean, this isn't just ambitious. It's an almost unheard of operational ramp-up they're guiding for.
Yeah, that really underscores the conviction management must have in their manufacturing scaling hitting an inflection point, like right now.
Absolutely. CEO Joe Mastrangelo commented, "The team delivered our strongest operational quarter-to-date production, scaled rapidly prior to subassembly fully coming online. Revenue nearly surpassed all of 2024. He also added, "We are continuing to expand our manufacturing capacity to provide our customers with the confidence in EOS's ability to deliver large-scale projects." This expansion they aim for is to reach an annualized rate of 2 GWh per year in the second half of 2025. That clearly forms the basis for that incredibly ambitious revenue target.
That 2 GWh rate is the linchpin.
It seems so. And supporting factors they mentioned include a growing commercial pipeline that increased by 21% sequentially to $18.8 billion and a current orders backlog of $672.5 million. They also highlighted strong demand drivers, things like data centers needing storage and large-scale energy storage initiatives, particularly in the UK.
Okay, so if we connect this all to the bigger picture, let's synthesize the key takeaways from this report for you, the listener. First, yes, there were revenue misses, but operational scaling is evident. Achieving record quarterly revenue, almost matching their entire 2024 revenue, that shows tangible acceleration in production. You can't deny that.
Right. The output is increasing.
Second, the gap loss obscures underlying progress. Those jarring headline gap losses were almost entirely driven by those non-cash accounting charges we talked about. When you look at non-GAAP metrics like adjusted EBITDA, and especially the significant year-over-year improvement in gross and operating margins, you see a much more constructive picture. It shows a business making steady operational gains, even if they're still losing money.
Getting less negative faster.
Exactly. Third, the balance sheet was fortified by transformative financing. That successful $336 million capital raise, plus the DOE loan, provided absolutely essential financial runway for them to continue their expansion plans.
Gave them breathing room.
A lot of it. And finally, the confidence in the H2 ramp-up sets a high bar. By reaffirming their full-year revenue guidance, management has signaled unwavering confidence in a truly dramatic operational acceleration. Achieving this target is now the absolute key catalyst for investors. It means this company is now essentially a pure play on execution for the next 6 months.
All eyes on execution then.
Absolutely. So, to kind of conclude our narrative for Q2 2025, this was really a pivotal moment for Eos Energy Enterprises. It's a story of strategic trade-offs. Yes, the company missed near-term analyst expectations on revenue and earnings, which, often happens when a capital-intensive manufacturing business scales up rapidly from a low base. However, beneath those headline misses lies I think, more significant narrative, one of operational progress and, critically, a successful and transformative recapitalization. This financing has provided EOS with the essential resources, the fuel, to pursue its long-term strategy of becoming a key player in the energy storage market. So in essence, the quarter was defined by exchanging maybe less than stellar short-term headline figures for a vastly improved long-term financial runway. The focus now shifts squarely to execution. That reaffirmed guidance sets a clear and very ambitious benchmark for the rest of the year.
Yeah, that sums it up well. We hope this structured deep dive approach has shown you how you can move beyond just the simple headlines and truly build a deeper understanding of companies like Eos Energy. It's really about seeing the bigger picture and the underlying drivers.
Exactly. And this structured approach, it isn't just for EOS. It's really a repeatable method, something you can use for building a deeper understanding of your investments over time, helping you analyze any earnings report with more confidence.
Okay, before we go, just a quick reminder. This deep dive is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. Please, always do your own research and consult a qualified financial professional before making any investment decisions. Also, this report was generated by an artificial intelligence model, integrating data directly from official company releases and publicly available market data. While it's designed for accuracy, you should always independently verify information. Like and subscribe to stockanalytics.ai. YouTube channel, members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.